Hey everybody, Ben Hart here. It is August 21st around 1 p.m. It's a weekly roundup. Thank you all for joining me today. We'll be talking about what's going on in the world, market events, what we see happening, and what we think will likely happen over the next little while. So I am on my own today, so I'll take some time to just give you an update on what's going on in the world. Typically, we cover the same types of core economic features that have an impact on you. So we cover GDP and inflation, which are the material parts, and then give you an update on just what we see happening in the markets, stocks, and a few things like that. So this week in Canada, we had a key CPI number on Tuesday, and that came in slightly lighter than expected. So we went from the likelihood of a rate cut in September, something around 25% prior to the meeting, got to somewhere in the neighborhood of 40% likelihood of a September cut after the meeting. So we will get an update on those numbers over the weekend here to see which way things are starting to lean. And in the US, we continue to see likelihood of a rate cut, something around 90% chance of a rate cut in September. So that'll be important to watch. All the world, though, is really looking at Jackson Hole this weekend. It's a small town in Wyoming where every year the central bankers, some other economic minds, and academics meet to talk about various things. But Chair Powell this week will be talking about, I think his key speech is around flexible, I think they call it flexible inflation targeting metrics. So something else to add to your financial vocabulary to see what they're thinking about there. But really, that's the piece I think that they need to put in place in order to give them some cover to cut rates into a period of sticky inflation. So, they're trying to manage both inflation, but also the financial conditions that are happening in the US, which is unemployment starting to rise now, which is making them a little bit concerned. And the US housing market as well is in a strange place too. So I think they are a little bit concerned about that. Or we have um, uh, new home builds and existing home builds starting to diverge from a price perspective. So that's unique and interesting to watch at this point. So without further ado, I think I'll jump into the charts and then maybe provide a little bit of context around what I see happening in the markets and anything that I may see happening next week. So just let me share this on the screen. All right. All right. Well, as I mentioned, we are August 21st, so anything that happens after this, we will comment on after that. So, as always, it's not necessarily they reflect the opinions of National Bank Financial. So inflation. So as I mentioned on the Tuesday print, we saw inflation start to come in as we look at this dotted line down the middle. It is Bank of Canada target, which is 2%. And then when we look over these various levels, the top line is 3-month CPI. The red one is 6 months, and the blue one is 12 months. So core inflation momentum has decelerated, as I commented on. So CPI well below the 2% level, and most recently came in at a 1.7 effectively. So that is why we saw that number move from 25% likelihood of a cut to 40. I'm a bit surprised it's not more than that because we've started to see unemployment tick up as well. So that data will be interesting to continue to watch in Canada. But Canadian housing market, or sorry, the Canadian economy is slowing. We saw unemployment starting to rise and housing, which we haven't talked about yet. We see the most recent housing data come out, and we've had 6 months in a row of housing prices decline, particularly in BC and Ontario, primarily Toronto, but BC and Ontario, we see housing prices kind of pulling down that the country average 6 months straight for the first time in a very long time. One of the other key areas that I like to think about and talk about is really just market positioning. And so oftentimes we have this conversation, well, speak with clients or institutions, just talking about different spots where and how is the market positioned. What do we think about that? What do we think about positioning? Why does the market do one thing over another? And I think that this speculative positioning is important data to look at, just to think about how potentially markets could move if something good happens or if something bad happens. You couple this with sentiment, and sentiment right now is, if you were looking on a scale of 0 to 100, you have probably 60 to 65 positive sentiment right now. So not overly aggressive that everything's roses, and not overly bearish that everything's terrible. So that's when you'd look at maybe institutional, we'll say, positioning at this point. And so this is a great chart to look at the different levels here. And so this is broken down by equities at the top, so S&P through to the VIX. We look at bonds. Well, it says rates here, but this is bonds, effectively, US bonds, FX, foreign exchange, and commodities. So what I look here is a couple things. Obviously, open interest is interesting. Some people pay attention to that, but net positioning, I think, is the more important thing to look at, and just thinking about where the risks and or opportunities are. And so if we look at this, we look at the Z-score. So a green number is very positive, a red number is very negative. And so when you have a very positive number, like his position on the NASDAQ right now, if there's any bad news that happens, there's risk to the downside. And then if we look down to look at potentially something else here, well, just right above it is worth looking at, is a Russell 2000. So pretty negatively positioned. Some good news happens, you could see a bounce in Russell 2000. Russell 2000 would be more leaning towards small mid-cap companies that are sensitive to rates. So if rates come down, tend to have a positive momentum swing on that side of things. The key area, which we've been talking about looking at for quite some time, continues to be in the rates market. And so if we look at rates as a whole, you get pretty negative divergence here. The 5-year, which I pointed at last time, I think when we looked at this chart, was again to continue to look at negative net short on the 5-year US bond. And so if you get some positive news, which could come out of Jackson Hole, good or bad, there could be some material news that comes out of that, because a lot of the things that Chair Powell and a number of the people at Jackson Hole will be speaking about will be rate related matters. What's happening to inflation and the economy in the US? If there is, we'll say a tone where they think rates need to come down faster, then you could get a material move with the bonds moving up quite quickly, particularly in the 5-year case, as per the positioning here. Again, if you get something to the other side of thing where Powell and some of the individuals there talk about maybe things are better than we expected, so we can push cutting rates, then you could continue to get a squeeze lower in this regard. Of interesting note, just before I move on to the next piece, is the long end. So you're looking at the 30-year, where the 30-year right now is up around that 5% level, 492, I think, as of this morning. And so as we start to move more and more towards that level, you actually start to see some natural buyers come out, where some of the institutions, pension funds, individuals that have, a need to use their actuarial calculations to meet their income needs, they start to get more comfortable buying duration when you get to that 5% level. And so a lot of the kind of, we'll say, risk to the long end has dissipated in the short term. So that, I thought, were a couple of the interesting pieces on this page. Just further to that, I've put this chart up before too, and it's really related to how bonds change in price. And so often today, if you were to say to somebody, I can buy a 30-year US Treasury at 4.9%, there's not a full understanding for what that means if interest rates change. Hypothetically, if I were to buy a 30-year today and I could guarantee 4.9% by the US government for 30 years. Nothing happens, price goes up and down for 30 years. I'm getting 4.9% a year for that period of time. However, what we know happens in the bond market is bond rates go up and down. And so we're starting today at 4.9, as I say, and assuming we get a move lower, say that 4.9 becomes 3.9, or we'll say 4%, just to keep it simple. you would, sorry, on this side, you'd get a 19.2% capital appreciation in your bond. So you bought it today, you get a 1% move lower, you get a 19% capital appreciation in that bond you purchased. The inverse applies. So if we go from 4.9% to 5.9%, as we do in this category here, you get a 9% capital loss in your bond if you were to sell it on that day. So bonds provide two types of things for you. And when you're thinking about asset allocation, I know there's been maybe this thinking, or at least I've heard it over the last many years, is there's no other alternative, so we buy equities. So the risk in the equity market's quite different, and rates are at much higher points than they've been for some time, as we've noted on this weekly call now for quite some time. So if you're starting at a 4 or 5% level and you do get a shock in the economy and you see rates start to come down, at least on the long end, you actually get a little bit of a benefit from owning bonds now, where in 2021, 2022, bond yields were much lower. And so you didn't get that buffer of your bonds moving up when the equities were going down. We're at a different position today where rates are higher. So having some bonds within the portfolio, maybe even something a little bit longer duration, could make sense. And this chart is a great example as to why that there could be some benefits that are outweighing the risks associated with buying bonds at this point. Like to do a lot of research as well, as always. I thought this was a bit of a fun one, just going through looking at a bunch of different places for research. And this is the chocolate candy heat map, and really give you a sense of the types of chocolate bars that are selling and what people are buying and what's going on. So, I thought this was a great way to look at it. And Hershey's, which is the number one selling chocolate bar in the US, is 16% of the overall market. That's actually falling. And then when I looked at, of course, down, you look at Mars as well. So Hershey's and Mars are a big chunk of the market. You're starting to see these levels fall. Interesting. So give you a sense of really how the basic level of consumer is thinking around things. I thought this was a great heat map just to think about what's going on in the overall economy. Some uptick in some of the higher priced chocolates was interesting. It does give you a sense of what the US consumer is thinking, but great chart breakdown. Think about, see if your favorite chocolate bar is up here on the screen. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. If you do have any questions, certainly feel free to reach out to your advisor or to me. We can see and answer any questions you have. Everyone's risk tolerance is a little bit different, and not everything might be suitable for you. Excellent. So that is the charts of the day today. And as I think about what happens between now and the end of the week, so we are Thursday, so tomorrow will be Chair Powell has a conversation around 10 o'clock talking about his view on what's going on with rates and markets. And again, as I mentioned, flexible targeted inflation he'll be discussing. And I think it's really that view to give him some flexibility, or at least give the central bank some flexibility to adjust rates even if inflation's sticky. And so I think that'll be one of the key pieces to pay attention to. Not often anything material comes out of these events and meetings, but the markets have been quite calm and complacent here the last, we'll say, 3, 4, 5 weeks. And so if there is anything material change that come out of that, we could see some volatility, particularly as we head into September. And so I'd be watching to see what comes out of those meetings and if there's any follow through. One of the key themes I've been mentioning in the daily this week is just the US consumer actually looks in a little bit better shape than they've been some time. There's some cash on the sidelines. There's expectations that spending will continue to go. So some of those US consumer discretionary names have started to look attractive. They've been beat up materially. Lululemon, Under Armour, some of those types of names have been beat up. So be starting to review and see if any of those things are appropriate to add into portfolios at this point. As always, thank you for joining us. Please feel free if you have any questions and would like a meeting, please reach out to Eva or to I. As always, please feel free to connect. So thanks very much for listening, joining me today, and hope everyone has a great rest of the week and a great weekend. Thanks so much.